Welcome to Earnings Recap. Today we're covering Domino's Pizza's earnings report and earnings call January-March 2025. If you enjoy this kind of content, please like the video and subscribe to the channel. So today we are really digging into Domino's first quarter 2025 performance.
Yeah, we've got the official 8K, the earnings release, and the transcript from the call they held back on April 28th.
Right, and our job, as always, is to sort of unpack all of that for you, put it to plain English. So let's jump right into the numbers first.
Sounds good. We'll start with the key financials from the report: sales, stores, profit, that kind of thing. Then part two, we'll get into the color from the earnings call, management commentary, analyst questions, the outlook.
Okay, so big picture first. Global retail sales for Q1 2025. What are we looking at?
They reported an increase 2.3%, so $4.46 billion globally, up from $4.36 billion last year.
Okay, 2.3%, but there's a currency impact story here, right?
There usually is, yeah. If you strip out the foreign currency effects, that growth actually jumps to 4.7%, so quite a bit stronger underneath.
Nearly double. So where's that underlying strength coming from? U.S. or international?
Well, that's the interesting part. U.S. store sales were up, but only by 1.3%.
Okay.
But international store sales, ex-currency, were up a pretty strong 8.2%.
Wow. Okay, so international is really pulling the weight there on the growth side, ex-currency.
It definitely seems like the bigger engine for growth in this quarter. Yeah. It makes you wonder if maybe the U.S. market is just more, mature.
Yeah, could be. So let's look at same-store sales then. That gives us a better idea of performance at existing locations. U.S.
Actually down slightly in the U.S., negative 0.5% for same-store sales overall.
Oh, okay. Down 0.5%.
Yeah.
How did that break down between company stores and franchise stores?
Company-owned stores saw a bigger drop, down 2.9%.
Right.
Whereas the U.S. franchise stores were only down 0.4%. So bit of a difference there.
Interesting. Maybe some operational differences or local market things affecting the company stores more?
Could be. But compare that U.S. dip to international same-store sales.
Okay, what did international look like?
Again, excluding currency, international same-store sales grew by 3.7%.
So positive territory internationally. Any specific regions driving that?
They specifically called out strong performance in Asia, particularly India, and also in the Americas, mainly Canada.
Right, so it seems like whatever strategies they're using in India and Canada are working quite well. Maybe something isn't quite hitting the mark the same way in the U.S. right now.
It does raise that question, doesn't it? What's clicking internationally that's maybe facing more headwinds stateside?
Okay, so sales picture is mixed. U.S. same-store sales down a bit, but international quite strong, leading to overall global sales growth, especially ex-currency. What about store counts? Are they opening or closing stores?
Globally, it was actually a small net decrease, down 8 stores overall.
Huh. Okay, a net decline. But does that tell the whole story?
Not really, no, because if you look just at the U.S., they had a net increase of 17 stores. They opened 20, closed only 3.
So still expanding the footprint here in the U.S. despite that slight same-store sales dip.
Exactly, but internationally, that's where the decline happened. A net decrease of 25 stores internationally.
Okay, how did that happen? Openings versus closings.
They actually opened quite a few, 203 new international stores, but they closed even more, 228 stores.
Wow, 228 closures. Where were those concentrated?
The report points fingers mainly at Domino's Pizza Enterprises, or DPE. That's their big master franchisee. Operates in Australia, New Zealand, Europe, and Japan.
Right.
And these closures were primarily DPE shutting down underperforming stores, mostly in Japan, as part of a sort of streamlining effort.
Right, so it sounds like a strategic move by a major partner, not necessarily a broad-based collapse internationally.
Precisely. It shows how actions by these big master franchisees can really swing the global numbers. But the good news, or the projection anyway, is that they expect most of these DPE closures to be done and dusted by 2026.
Okay, got it. Let's shift to the actual money then, revenues and profits, total revenues.
Up 2.5% to $1.11 billion.
And what drove that increase?
A few things. Higher U.S. franchise advertising revenues was one.
Why was that up? Just more advertising?
Not exactly. It was more about Domino's offering fewer incentives or discounts on the ad fund contributions to franchisees. They returned to the sort of standard rate.
Ah, okay. So a change in the fee structure, essentially. What else boosted revenue?
Higher supply chain revenues. That was mostly driven by them charging stores more for the food basket, about 4.8% higher pricing on ingredients and supplies.
Okay, passing on some costs there.
Seems like it. And then, naturally, higher international franchise royalties and fees, which makes sense given the sales growth we saw there. Though foreign currency took a $3.2 million bite out of that.
Always the currency impact. Okay, what about profitability? Did those higher food costs hurt margins? Let's start with the U.S. company-owned stores.
They did, yeah. U.S. company-owned store gross margin decreased by 1.5 percentage points, came in at 16.0%.
And the reasons?
Primarily those higher food basket costs, plus what they called lower sales leverage. Basically, with sales down slightly in those stores, fixed costs ate up a bigger chunk of the revenue.
Makes sense.
Yeah.
But was it all margin pressure? How did the supply chain do?
Actually, the supply chain side did better. Their gross margin increased by half a percentage point to 11.6%.
Oh, interesting. How did they manage that?
They attributed it to procurement productivity. So basically, they got better or more efficient at sourcing their supplies, which helped offset some cost pressures.
Okay, so looking at the overall operating profit.
Income from operations was down just slightly, 0.2%, landing at $210.1 million.
But again, currency.
Currency. Take out that $3.2 million negative hit, and operating income was actually up 1.4%.
So underlying operations still positive ex-currency. What
Yeah.
drove that modest underlying increase?
It was really that improved supply chain margin and the higher international royalties doing the lifting, but that was partially offset by higher G&A expenses.
G&A, anything
Yeah.
specific there?
Yeah, they mentioned about $5 million in severance costs tied to an organizational realignment they did.
Okay, we'll probably hear more about that realignment on the call. Now, net income, the bottom line. That saw a big jump, didn't it?
A huge jump, actually. Net income was up 18.9% to $149.7 million.
Wow, nearly 19%. What fueled that? If operating income was only up slightly, ex-currency.
Yeah, this is interesting. It was largely driven by a big swing, a $42.7 million favorable change in unrealized gains and losses from an investment they have in something called DPC-LTD.
DPC-LTD. Okay, not sure what that is, but a $42 million gain certainly helps the bottom line.
Absolutely. It wasn't core operations, but it significantly boosted the net income number for the quarter. That gain was partially offset by higher income taxes, but still a big net positive.
And that flows through to earnings per share, right?
Correct. Diluted EPS was up even more, 20.9% to $4.33 per share.
Why was the EPS growth higher than the net income growth?
Two reasons. The higher net income itself, and also a lower share count because the company bought back some of its own stock. Fewer shares, higher profit per share.
Standard playbook.
Okay.
Let's quickly touch on cash flow and how they're using their cash.
Cash flow from operations looked pretty strong. It increased by 45% to $179.1 million.
And capital expenditures. Spending on new stores, equipment.
That actually went down. CapEx decreased by about 27% to $14.7 million.
So, more cash coming in, less cash going out on big investments. That means a big jump in free cash flow. It was up almost 60%, 59.1%, reaching $164.4 million.
That's a healthy chunk of cash.
Yeah,
Some options, right?
Definitely. Lots of flexibility, and they use some of it to return capital to shareholders.
How so? Buybacks and dividends.
Yep. They bought back $50 million worth of stock, about 115,000 shares, and they still have over $760 million authorized for future buybacks. Plus, they declared their regular quarterly dividend, $1.74 per share this time.
And finally, any change in their debt levels. Leverage ratio.
It's a slight improvement there. Leverage ratio ticked down a bit from 5.0 times last year to 4.9 times this quarter, so managing the debt okay. Okay, so that covers the key numbers from the report. A bit of a mixed bag, U.S. sales softness, international strength, some restructuring costs, but a big boost to net income from that investment gain and strong cash flow.
Yeah, that sums it up pretty well. Now let's get into the earnings call and see what management had to say about all this.
Right, context time. CEO Russell Weiner was apparently pretty focused on their strategy called Hungry for More. What's the gist of that?
The main message was that this strategy is the key reason they believe they're gaining market share, both here and internationally, even with, the economic pressures everyone's feeling.
Okay, and it has pillars, right, like focus areas.
Yeah, 3 pillars he talked about. First one, most delicious food.
Makes sense for a pizza company. What was the news there?
The big thing was the launch of their Parmesan stuffed crust pizza. Weiner really hyped this up as a major innovation, something to fill a gap they saw in their menu and drive share for, years to come.
Stuffed crust is popular. How's it doing so far?
He said early signs were good customer feedback positive, fitting well into the order mix, but he also linked it to the second pillar,
Which is?
operational excellence. He stressed that launching something more complex like stuffed crust requires really solid operations in the stores.
Right, you can't mess that up. How are they driving operational excellence?
Mentioned ongoing training programs and also their tech platform, Domino, helping stores run more smoothly. You need that solid base to execute new menu items well.
Okay, food operations. What's the third pillar?
Renowned value. This covers how they compete on price and promotions.
What falls under that umbrella?
Things like their national deals. He mentioned the best deal ever, which was like any crust, any toppings for one price. Also the loyalty program, Domino's Rewards, and their growth on third-party delivery apps, the aggregators.
Value. So the best deal ever, was that just about being cheap?
He framed it more as offering real value, not just the lowest price point, and apparently franchisees bought into it. Good participation.
Okay. And you mentioned aggregators. That DoorDash deal was new, right?
It was. Big news. They officially announced the partnership with DoorDash, said the national launch should be completed by the end of Q2, so like end of June 2025.
What are they expecting from DoorDash? Is it all new customers?
Their initial thinking is about 50% incrementality, meaning half the DoorDash orders will be customers who wouldn't have ordered Domino's otherwise.
Okay, 50%. Is that similar to what they saw with Uber Eats?
Yeah, he said it's similar to their overall expectation for aggregators now that they're on multiple platforms. Interestingly, though, he noted DoorDash's pizza volume is apparently about double Uber Eats.
Oh, wow. So potentially a much bigger pool of customers to tap into via DoorDash.
That seems to be the hope. They basically see aggregators now as just part of the overall delivery business, not some separate thing.
Makes sense. Now, you mentioned severance cost earlier from an organizational realignment. Did they talk more about that on the call?
They did. Wiener explained they made some changes to create a, quote, faster, more efficient structure that lines up better with the hungry for more strategy.
Which involved?
Some role eliminations, unfortunately. That's where the $5 million in Q1 severance came from. But they emphasized the savings from this won't just drop to the bottom line.
Oh, where are the savings going?
Mostly reinvested back into the business. Things like consumer tech, store technology, and capacity investments. So trying to fuel future growth.
Okay, strategy, food, ops, value, DoorDash, restructuring.
Yeah.
Let's talk outlook. What are they forecasting for the rest of 2025?
For the full year, they expect global retail sales growth to be generally in line with 2024. So similar pace overall.
And U.S. same-store sales. They were down slightly in Q1.
They're still aiming for around 3% growth in U.S. same-store sales for the full year.
3%. How do they get there from being down in Q1?
They expect it to be back half weighted, lower growth in the first half, picking up later in the year as initiatives like DoorDash and maybe the stuffed crust gain more traction.
But they added a caveat. Right.
They did. Acknowledged that macroeconomic pressures could make hitting that 3% target challenging. So a bit of caution there.
Okay. What about international same-store sales growth for the year?
More cautious there, too.
What?
Forecasting 1% to 2% growth ex-currency.
Why the lower forecast internationally compared to the U.S. target?
They cited those macroeconomic pressures again, but also specifically mentioned geopolitical pressures and volatility as potential risks that could impact demand in some international markets.
Got it. So sales outlook is a bit mixed, maybe cautious. How about profit? Operating profit growth.
They're projecting approximately 8% operating profit growth for the year. That's excluding currency impacts and also excluding those Q1 severance costs.
8% profit growth.
Yeah.
That's pretty solid, especially if sales growth is more modest. Any comment on tariffs?
Yeah, they mentioned they don't expect tariffs on domestically sourced food to have a material impact on that profit number.
Okay. And store growth plans for the rest of the year?
U.S. Still targeting 175 net new stores in the U.S. They seem confident about that, citing strong franchise economics and a good pipeline of new locations.
And internationally? Still dealing with those DPE closures.
Yeah, the international net number for the year will definitely be impacted by those closures, most of which happened in Q1. But they stress that outside of DPE markets, places like India are still showing strong unit growth trends. And again, they think the DPC drag will mostly be over by 2026.
Okay, that covers the main outlook points. What about the Q&A with analysts? What were they pressing management on?
Well, definitely those international geopolitical pressures. Analysts wanted to understand the risk better and how it factored into the cautious 1-2% same-store sales guidance.
Oh, makes sense.
DoorDash, of course. Lots of questions about the expected impact, that 50% incrementality number, how it compares to Uber Eats in practice when they'll really see the benefit.
Trying to model the impact, yeah.
Exactly. And the Parmesan stuffed crust analysts wanted more detail on how it was performing early on, the mix, customer feedback.
Were they happy with the answers?
Management seemed pleased, said it was meeting expectations, hitting the right notes. They see it as a big opportunity versus competitors, and also something that gives a sort of deliciousness halo to the whole brand.
The deliciousness halo.
Let's go.
Okay. Anything else grab the analyst's attention?
Loyalty program came up seen as a multi-year driver, especially for carryout customers and lighter users. They mentioned strong growth in active members there.
And carryout itself, how's that doing?
Carryout growth was about 1% in Q1. Management noted they were lapping a tough comparison from last year when they had a big carryout deal and launched the revamped loyalty program. But they still expect both carryout and delivery to contribute to hitting that 3% U.S. comp target for the year. Carryout still has room to grow its share, apparently.
Right. And the competitive landscape. Always tough in pizza.
Very much so. Acknowledged it's intense, competitors are also doing things like stuffed crust. But Domino's feels their franchise economics, their scale, gives them an edge, especially in offering value consistently over the long run.
Do they think the pizza category itself is growing?
They mentioned the category typically grows maybe 1-2% a year historically. Their goal isn't just category growth, though. It's continuing to take market share, which they've typically done, maybe around 1 share point per year.
Okay, so wrapping this all up. Q1 2025 for Domino's. Sounds like they navigated a tricky environment. U.S. same-store sales dipped, but they feel the hungry for more strategy is gaining share.
Yeah, and they have these big levers. They're pulling the new stuffed crust, the big DoorDash partnership rolling out nationally soon. Those seem key to hitting their back half growth targets.
Meanwhile, international performance looks stronger on the sales side, but they're being cautious about the outlook there due to those macro and geopolitical factors, plus the DPE store closures impacting unit growth this year.
Exactly. So a few things for you listening maybe think about. How much of a boost will DoorDash really provide? Will that 50% incrementality number hold up once it's fully national? And what about that stuffed crust? Will it be a sustained hit, really change the sales mix?
Yeah, and maybe how well can they actually navigate these economic headwinds and the competitive pressure to hit that 3% U.S. comp goal and the 8% profit growth target for the full year? Lots of moving parts.
Definitely. It's a snapshot, right? A company in motion, executing a pretty complex strategy. How all these pieces, innovation, operations, value, partnerships interact will really determine how the rest of their year shapes up. It'll be fascinating to watch.